terms of the Q3 profit warnings report, lots going on clearly in terms of it. The report, was great. Lots of stuff that we can talk about. I guess, where do you want to start?
So if I start with the headline number, there were 64 profit warnings, which was quite a bit down actually on Q3 last year, a little bit up on the quarter before. But actually, if we look across the piece, we've still got about 18% of the whole market warning, which is about the same level we saw in 2008. So if we think of that as the high point, the kind of recessionary point, then we're still seeing a really high number of companies warning.
Right, okay. And in terms of sectors, what are the key sectors? Having looked at the report, I can pick out a few, but you sort of tell me what you think you were finding.
Yeah, so I think the really interesting ones this time round were software and computer services,
right,
where people may be not expecting to see a kind of high level of profit warnings. Construction, where people probably are expecting to see a high level of warnings. Clearly, there's a lot going on in construction at the moment. Retail again, but retail was interesting because the third quarter doesn't usually see a high number of retail warnings. Retailers usually like to wait into the fourth quarter to see how Christmas is the golden quarter to see how things are going. And media, I think media is a really interesting sector, and there's clearly a kind of lot of disruption going on in there. That's probably the sector where we're seeing a lot of kind of disruption through changes in model, changes in kind of with the way that consumers consume media, and AI as well. That's where we're seeing that come through.
Coming back to the technology, there's lots of noise at the moment around correction, around tech, and around the AI bubble at the moment. We see it every day. Do you think the correction is looming? Is that an indication with the Q3?
So in terms of what we're seeing, we've seen a relatively high level of software warnings and actually business services warnings as well, kind of essentially linked into, well, for software, there's two things. There's a pandemic hangover. So there's a lot of money spent during the pandemic. I still think we're seeing that come through now. And just a general pullback in business spending. So businesses, and we're seeing that through, again, that's actually through media, through business services and software, where we're seeing a really high level of profit warnings talking about businesses pulling back on spending. Either they're cost cutting or they're hesitating because of just the general uncertainty in the economy at the moment.
And in terms of the warnings, I can't remember the detail in the report, but were there strong indications around slow growth? Lots of the industries that we're seeing on a broader scale at Company Watch, really slow growth. You link that to possible business rate rises. Chancellor Reeves made her pre-budget statement at Downing Street yesterday. I think we all sort of took a deep breath as if to say, okay, what's going to come in terms of 3 weeks' time? Is that following through in terms of the warnings?
So I think in terms of profit warnings, I'd see it in layers. So I would definitely see growth as a fairly fundamental layer that's been there pretty much since the financial crisis. We've had a lower trend growth in the UK, and that's clearly the foundation and fundamental, and for a lot of sectors that's a kind of fundamental issue. We had about half of profit warnings talking this time around geopolitical uncertainty and policy uncertainty, and sometimes, as with tariffs, it's hard to kind of separate the two, but there is clearly a lot more of that happening. I would say a couple of years back this was something that we'd pick up in about sort of 2-3% of warnings, not 47% of warnings as we did this time. So there's clearly that, and then there's another layer of what obviously companies can have their own kind of reasons why they slip up, but we're also seeing other things come through like cyber attacks and kind of foreign exchange, which is again kind of linked into that kind of volatility. So there's an awful lot going on at the moment, which is why we're having so many companies warn, because you've got that fundamental difficulty plus all those other kind of overlayers on top.
And in terms of the warnings, do you think do you think they're warnings around, there's quite a lot of uncertainty right now. There's a lot of instability right now. You mentioned, the geopolitical situation. Tariffs are playing a big part. If we look at sort of employment in the UK, they're sort of forecasting that employment is going to be about 5% by the middle of next year, particularly in retail and hospitality. I guess that's a massive. It's been a massive issue for quite some time. So are they key factors?
Yeah. So uncertainty, definitely. Uncertainty has been if I look through sort of profit warnings the last couple of years, there has been that kind of underlying uncertainty about what's going to happen. Obviously, this has really ramped up in the last year, and we've seen tariffs sort of come through. We've seen those geopolitical issues, that kind of feeds through generally into kind of mainly for the last couple of years, we've seen it in business to business spending, and certainly like since the tariff, we've seen that more in the kind of business to business area and that kind of geopolitical uncertainty. I think what really changed over the summer was the shift into consumer confidence. So last summer we saw probably about 6% of warnings, I think it was, talking about low consumer confidence. This time across the whole piece, not just in it's obviously high if you just go into consumer, across the whole piece, it was about 1 in 5 warnings talking about weaker consumer confidence. I really think that has kind of started to come through now into consumer. And as you say, that's why we saw a high level of retail warnings. But hospitality and travel. So in hospitality clearly has had the hit from kind of higher employment costs as well. But we're seeing in areas like casual dining where there's kind of more pressure. And in travel, clearly people are still like wanting to travel and have experiences, but people are booking later, which is generally another sign of that kind of weaker confidence.
How about pharma? Pharma's been hitting the news headlines for the last 6 months by the feel of it. Was there any signs in terms of the pharma market?
I would say more broader across the healthcare sector. So again, this kind of goes back into that policy uncertainty and policy change. Also in some elements of healthcare, again, kind of employment costs. But more broadly across that healthcare sector, we are starting to see a pickup there in terms of warnings, because if you have like NHS reorganisation, kind of change in US kind of medical care as well, the different elements of that kind of pulling together. So yes, definitely across healthcare more broadly.
And in terms of, I can't turn a page of any newspaper or article at the moment without seeing the business rate sort of rise, anticipation. Do you think we're going to get a business rate rise?
There's clearly been a lot of lobbying around the topic. I'm not sure. I think there is a talk around having a business rate rise for like the larger, which I think like supermarkets and wholesale. And so where we have seen profit warnings is in that kind of wholesale to convenience kind of sector. So that would clearly be an issue if business rates rose for those kind of larger properties. Obviously, they're more targeted at kind of helping the high street versus online. But as with all tax changes, you can have unforeseen consequences.
And in terms of funding, where does funding play a part in this? Do you see the access being shortened? Do you think that finance market is going to tighten in terms of where we're at the moment?
I think this is the interesting thing, is probably why we haven't seen as much in kind of insolvency as we maybe might have expected, given the pressures, that funding has been more readily available than in say previous kind of recessionary cycles, and we've seen relatively high liquidity through this cycle coming out of the pandemic. And now, even with relatively high interest rates, liquidity hasn't really been a kind of serious issue. It's really hard to call the end of it. I think people have been calling the end of it for like years and years. It's like, it's one of those really hard things. It's like betting against the housing market. It's really hard to say, but I think there are some elements where we are seeing tightening, where it may be in some businesses where you are kind of linked into kind of ESG cycles, where you're kind of like seeing long-term kind of changes in that sector. Maybe lenders might be looking ahead and thinking, how far ahead do we want to keep funding this business? But it's not a major issue. There is some tightening around the edges, but not across the whole piece.
I also think sometimes these situations, they sort of do breed opportunity as well. And certainly there'll be innovative financiers that will look at this market condition right now and say, hey, there's an opportunity here.
Yes.
So I think in terms of new entrants into the market or growth into the market in terms of alternative financing and new ways of financing, we've seen it over the years. It always brings about creativity.
Yes.
And I think that's actually positive, isn't it?
Yeah, we've seen private finance kind of fill a lot of the gap. Again, one of the reasons why we haven't seen like liquidity really tight. You may see less bank funding, but there's more alternative finance out there. One of the other things that, there are always new entrants into markets. There is, in terms of all the disruption we're seeing across different markets, well, then that's kind of good in a way that you have a turnover of companies and kind of, new entrants coming in.
Yeah. Do you see any pressure in terms of governmental pressure on some of the companies that you're looking at? If I think about the wider corporate market, at Company Watch, we constantly monitor the trends around winding up petitions from central government, from HMRC in particular, and that tends to be the final straw for many businesses that we see going into insolvency. And I'm talking about SME mid-market type of companies from a volume perspective. Labour costs. Do you want to go?
Yes.
Talk a little bit about labour costs.
Yeah. So labour costs we have seen. I would put that in the broader category. That would come into the broader category of policy change. So we're definitely seeing more of that come through. So it's interesting. Obviously, we saw after the pandemic, we saw labour costs go up. Now we're talking. Obviously, there is the impact of the national insurance changes and the national living wage, and we have seen clearly an increase in companies talking around that, particularly, as you say, in like the retail, the hospitality and the healthcare sectors. That's clearly an issue for them.
And in terms of bringing it back to retail, now we're into the golden quarter. I guess a lot does reside on what happens now during this final period as we go into next year. What are your expectations in terms of the retail world, I guess?
So I never bet against the consumer at Christmas. I think people will always spend or want to spend at Christmas. Clearly there's a pressure on the cost of living at the moment, and clearly, you know, maybe we may see some cutbacks around the edges, but generally consumers will spend at Christmas. But given everything that's happening at the moment, that creates probably an issue more going into the new year. I would maybe look at like next year. Clearly it kind of depends what happens around the budget and in other elements around kind of inflation and interest rates. But I think next year possibly could be the tough point. But clearly retailers are kind of struggling to get money through the door at the moment. I mean, I've been barraged with Black Friday emails already. So, you know, clearly there are some pressures around some retailers to get money through the door. Yeah.
I'm going to bring it back to cyber risk.
Yes.
Our clients have asked us to introduce cyber risk assessments into the product. We've now done that. We launched that 3 weeks ago. So really from, you know, the SME mid-market and the larger companies that we work with as well, cyber is playing a big part. In terms of the profit warnings, was that a part of it?
Yeah, so what we saw was the impact of cyber attacks through the supply chain. So I think when we've seen cyber attacks come through before, so we've been doing this report for over 25 years now, we've seen the impact of cyber attacks before, but they've generally been isolated to one company. I think what we're seeing now is clearly the impacts through supply chains, because it doesn't just shut down that one company or part of one company. It has an impact all the way through their supply chain. So it's definitely something to kind of watch out for now. And I think it's definitely risen higher up the agenda through some fairly high profile kind of attacks this year.
In terms of fraud, is that an area that is being cited in the profit warnings at all?
Yeah, we've had some fraud, and clearly you've got different levels of fraud. It would have to be quite significant to kind of obviously come through into a profit warning. But kind of where you've got fraud or kind of I would say kind of the broader risk management across a business unit, they tend to be quite significant profit warnings where basically there hasn't been adequate contract or risk management within a business unit. Those are the ones that I tend to watch for, because they can clearly kind of spiral further, and they also kind of speak to the culture of the company as well, which is why investors will often kind of react quite badly to those warnings.